to discuss this. So what are your takeaways from the rotation that we've seen, really away from some of the growth stocks?
Yeah, so look, I mean, a lot of people have been of the opinion that we're maybe at the start of a correction. I'd actually argue we may be towards the end of it, in the sense that this has not been a traditional correction. This has really been more of what's called a tectonic shift away from technology into financials, into materials, into energy, all of which are part of that value style. And all of that is as a sort of response to the yield curve steepening the way that it has. Now, in listening to your prior guest, I actually think that tech probably short term starts to maybe get a bit of a bid. And I'm saying that purely because it looks like bonds may be stabilizing at these yields. Long duration treasuries are catching a bid here. Inflation expectations, I would argue, are a little bit too extreme given longer term debt deflation, which is still very much on the horizon. And all that would bode well for tech in general. And, I put out these various white papers, these various signals that tend to get ahead of high risk periods. And there's a lot of conflicting information. Lumber relative to gold is weak, but not that weak. Utilities are strong, but not that strong. Treasuries are improving, but not so much. So, I think there's a longer term case for value, but I think also short term, the tech sell off is probably overdone.
So where are the opportunities? I know that you were watching gold very closely, but as a portfolio manager, I know you're always trying to look for making money, ways to make money. We have a lot of stimulus. Inflation is likely to rise some. Where do you make money?
Yeah, look, so broadly speaking, the cheapest asset class I still maintain is commodities, right? And we've seen quite a bit of movement in the commodity space, and I suspect that's still fairly early, and all that would argue for the value style continuing to outperform longer term if that cycle from a secular perspective is there. Gold is interesting because gold really hasn't participated with the broader commodity run, and I suspect that as this infrastructure bill comes out, there's going to be a portion of the investment community that starts to question how much longer we can keep on spending without consequences. And to that extent, I do think gold does have a demand surge coming potentially from those that would view it as a form of discipline in a government that doesn't seem to care about budgets. And so I think there is going to be some movement there. And I talk to advisors all day long. A lot of advisors are very unclear on how to properly diversify their portfolios. Very few things are non-correlated. Gold is one of them. So I do think that gold will start to catch a bid on, again, this realization that at some point the piper's got to get paid with all this spending that's going on.
So you think commodities are the cheapest with the opportunity here in gold, which has the opportunity maybe to have a little bit of surge. Very different story than the Bitcoin picture. As people watch 51,000, they wonder when it's going to breach back down below 50,000. So completely different. What about the rate environment and what that could mean for investments? I mean, a lot of people really like financials, for example. They think a rising rate environment is probably good news.
Yeah, I think that's right. So look, when people talk about rising rates, I think they focus on the wrong rates, right? The rates that really matter from a risk on, risk off perspective are the rates in junk debt, right? Sort of credit spreads in terms of high yielding corporate issues and U.S. Treasuries. And credit spreads really haven't widened in this volatility that we've seen in the last month and a half. So I think as long as the yield curve keeps steepening and you have rising rates on the long end, to your point, financials should benefit from that, although probably not as much as historically they have. There is going to be a natural stopping point, which again, I think short term may be around here. And that degree of stability will probably at the margin help broader bullish sentiment. Again, help tech probably more so than financial short term, but still have that sort of longer tailwind for the financial sector from an asset allocation perspective.
I know you said you thought at one point tech was overdone and you're seeing this pullback. Is it enough of a pullback to bite into some tech areas to buy?
Yeah, I mean, I think it depends on which areas, right? If you're talking about sort of the
tell
gig
me.
economy, right? The gig economy stay-at-home stocks, which were on fire and now have 30, 40, 50% drawdowns off their highs. Some of those are probably overdone because there's obviously this tremendous hope around vaccinations and reopening, and at the margin demand lessening for those stay-at-home type tech plays. But the longer-term case, I think, is still there. I think you'd be hard pressed to argue that the behavior of people will change, to extent that we are living in a new world. And these areas will probably still keep on seeing some degree of demand. Listen, everyone's excited about the vaccines and COVID seemingly coming to its end. We don't know it's over until it's over. And I think from that perspective, there's still going to be some residual demand for stay-at-home stocks, which are in the tech sector.
Yeah, right. Yeah. And, we were just looking at some of the material stocks like steel, for example, as we're seeing different sectors, right? Materials, energy, tech, real estate among the best. Intel, Cisco, Home Depot, a winner today, right? We've seen that at highs. What's your final thought? Because people really love to try and make some money, and they look to people like you for some guidance.
So if you go with me that the commodity secular move is probably here, right? That you have sort of a longer term case for commodities, that's going to bring with it different boom and bust cycles within that broader secular trend. So I think from an investment standpoint, you want to try and play on the reflation trade, play financials, play cyclicals, play materials, play energy. If you're a short-term trader, you probably want to play tech. If you're an asset allocator, I think you want to be careful across the board because I still think there's going to be a lot more volatility to come. I think risk on, risk off is far from over. And from that standpoint, diversifying across not just asset class, but strategy probably makes the most sense.